I think gold is going much, much higher. It's just a matter of the time. So number one, great wedge pattern. Look at how when it broke out, it was a awesome breakout. Now, I do think you are going to get a retrace here. We're probably going to come back towards 4,000, maybe even 3,900. But at this point, once you get the breakout, you buy the pullbacks. This downtrend has been broken. All right, that's number one. We're starting to get slightly higher lows and now slightly higher highs. And so, again, the breakout is there. I do have it penciled out based on a calculator and calculations that I've done, is that by 2029, 2031, we'll be at 13,000 on gold. That's my calculation at this point. So I think, listen, there's a small part of me that still thinks gold could go down to 3,500. That was kind of my worst case scenario, where I'd be like buying with both hands, physical metal, etc.
Gold and silver are igniting massive interest across global markets as fresh technical breakouts break key downtrends, sending traders into a frenzy. Escalating geopolitical tensions in the Middle East, deadlocked trade routes, and relentless record-breaking central bank purchases led by aggressive monthly additions from China are rapidly driving safe haven demand. With inflation risks resurfacing and broader markets facing volatility, investors are urgently watching precious metals to capture the next explosive leg higher. In this exclusive breakdown, technical market strategist Gareth Soloway analyzes the latest gold price action, highlighting a textbook wedge breakout while forecasting a short-term pullback toward $4,000 or $3,900 as a prime buying opportunity. Soloway lays out his bold long-term mathematical target of $13,000 gold by 2029 to 2031. Compares gold's powerful trajectory against Bitcoin's sluggish price action, and reveals the critical macro triggers that could unleash the next massive rally. Could this impending pullback be the final chance to buy gold before it rockets to historic new highs? Watch until the end to find out. But before that, if you find this analysis helpful, please hit the like button, subscribe, and turn on notifications so you never miss our deep dives into the markets. Thank you for watching, and let's get into the video.
Let's move on to gold now. Like I mentioned in the beginning, gold spiked at the same time that the S&P did. Right now, though, is momentum strong enough that you would be looking at another retrace towards $5,000 an ounce?
So I think gold is going much, much higher. It's just a matter of the time. So number one, great wedge pattern. Look at how when it broke out, it was a awesome breakout. Now, I do think you are going to get a retrace here. We're probably going to come back towards 4,000, maybe even 3,900. But at this point, once you get the breakout, you buy the pullbacks. This downtrend has been broken. All right, that's number one. We're starting to get slightly higher lows and now slightly higher highs. And so, again, the breakout is there. I do have it penciled out based on a calculator and calculations that I've done, is that by 2029, 2031, we'll be at 13,000 on gold. That's my calculation at this point. So I think, listen, there's a small part of me that still thinks gold could go down to 3,500. That was kind of my worst case scenario, where I'd be like buying with both hands, physical metal, etc. It only got down to 3,900. But at this point, you know, you see the writing on the wall. Like we've talked about it in this interview, all the negatives that are ultimately a positive for gold, even silver, and so on and so forth.
You know what's interesting is that we talked about the gold price popping. We talked about S&P popping around the end of July. Bitcoin's still flat. In fact, it's down today.
What we're seeing is, so number one, we actually did get a breakout on Bitcoin, and it's probably one of the weakest breakouts I've ever seen in my life, because you can see this trend line goes to the from the all-time high down to this pivot. We hit it, then we hit it again 3 times here, and we finally got through the line. Now with gold, what did gold do? When gold got through its line, it like ripped higher. Bitcoin just petered out, and as long as it stays above this white line, there's actually a bullish angle to this, meaning probability actually favors upside here in the near term on Bitcoin. But I think what's going on here is that you have all these other assets. I mean, semis are starting to rally. The stock market's at all-time highs. Gold is going. Bitcoin, who wants to be in Bitcoin at this point? Like, no one. I mean, even Michael Saylor's had to sell like 100 million to cover and buy other things and cover dividends. The one thing, again, I will say, I'm short-term bullish on Bitcoin, and I think also the Clarity Act issue. So you had the Congress punt the Clarity Act to the next session. That just happened days ago when they went on break. Now they're not coming back till September. So I would think that probably late August you start to see an uptick here. But we're just continuing to hear that these meetings, these things on clarity, it's just not helping. It's not getting forward. And that's honestly disappointing for anyone in crypto who voted for Trump because he was pro-crypto. The crypto stuff has really not panned out. And my thesis here is, and I'll tell you this, one of the reasons why I'm near-term bullish is I do think that the president will want to get crypto voters back to the polls or back to the voting boxes in November, and he's going to try to push that Clarity Act through before the midterms. And I think that will give you a 10% to 15% run in Bitcoin, maybe even more, taking it into the 75,000 range. What I will say, at least for Bitcoin is the one thing out of all of them that at least maybe there's a glimmer that it's that alternate to gold, or that angle to, diversifying against money printing and fiat. Now, again, every bear market, people doubt it. But so far, the bear markets have been every 4 years, and it's come out the other side. I'm not convinced the ultimate low is in for this cycle, but I am convinced pretty highly that we will see a rally in the near term here over the next month or two in Bitcoin that'll send it up again, back into the mid 70s, maybe even touching 80. Again, that'll be based on whether or not the president starts to court those investors and gets excitement back.
Beyond precious metals, technical strategist Gareth Soloway is turning his focus toward the broader macro picture, mapping out an explosive stock market trajectory with a looming economic wall. Driven by a weakening U.S. dollar and flatlining 10-year Treasury yields, Soloway projects the S&P 500 will surge through minor pullbacks and rally straight to $1,100 to $8,200 by year-end, bolstered by geopolitical shifts away from direct military conflicts ahead of the upcoming midterm elections. However, his deep dive technical chart dividing the S&P 500 by the M2 money supply exposes a far more precarious reality. Hitting $8,200 would make stocks relatively more expensive than during the peak of the dot-com bubble, signaling a major structural top and setting the stage for a dramatic market crash starting in 2027. Will this historic liquidity push trigger the ultimate blow off top before the broader economy finally collapses? Watch to find out.
I also think there's a bigger dynamic going on with the U.S. dollar. You brought up the dollar yen just a little while ago, but look at the U.S. dollar breaking here. And we know the stock market likes a weak dollar. Multinationals make more money when they convert those other currencies back to dollar if the dollar is dropping. And then the 10-year yield and the 30-year yield, which still remain at ridiculously high levels, at least they're not pushing up, right? So if we go to the 10-year yield here, and we take a look, you can see it's really flatlined ever since, interestingly enough. I mean, you could really go back to May, the high pivot in May. We've just been stalling around here, and that's giving investors a little bit more confidence that, essentially we're seeing a slowdown. And I think we can't overlook, and sorry to ramble here, but we can't overlook the oil price as well. Oil, again, was popping up as missiles were flying and strikes were going on, and all of a sudden, basically, the president has said we're going to do economic sanctions on Iran, but we're not going back to missiles and attacks. And what does that mean? It means the midterms are getting pretty darn close, so we can't be having a war and continual casualties going into midterm elections. And that's really where I worry about the stock market. I think through the midterms, probably fine, maybe 2%, 3% drawdowns, which is just normal, but then pushes to all-time highs. I think we hit 81, 8,200 by year-end. Then starting in 2027, that's where I'm going to get concerned. Now, let me show you this chart here, and this is why I think the 82 to 8,300 level is appropriate to mark on. So number one, here's a chart of the S&P 500, right? So we were in this parallel channel since COVID's low, bull market 2021 highs, and we talked about this in past interviews. Here's your lows of the bear market in 2022 and 2023. Here's your tariff sell-off down to that same trend line. We then went to the high end, but look, we broke out. So we broke out of the channel, and then all of a sudden a resistance level, remember it was resistance here and resistance back here, it now became support. And so this is kind of my level in the sand, if you will. As long as we stay above here, it remains bullish, and it held, and we've gone higher. Now, if we continue up, there's one thing that is paralleling here. We take a trend line right from here, right? So these levels, and essentially we bring it up to this high point here. Okay, and I'm going to change the color on that so it pops out for all you guys that are watching. If you look at that, that's the logical next parallel to get hit. And where is it? It's right around 8,200, 8,100. Now, you might say, okay, well, it's a parallel, no big deal. I want to show you another chart that's even wilder here. So let's get rid of these drawings. Let's do the S&P divided by M2 money supply. Now, the reason why M2 is so important is that M2 is how much money's in the system, essentially. So in theory, the more money in the system, the more money that's being created, the higher the stock market can go because some of it always finds its way in. So if we go to US M2, so let's divide SPX by US M2, and we bring up this chart, I want to show you this. If we go to our weekly chart and we go back to the .com high right here. So here's your .com bubble high. Here's your low from 1982. Here's your collapse, financial repression or recession, the big financial crisis low. So you're connecting two pivots, and guess where this would go? How much higher it would go if we hit 8,200 on the S&P? We would top out on the M2 money supply factoring when looking at the S&P. And I hope I explained that clearly enough, but that would essentially mean that we are more expensive in terms of M2 than at the .com, but it would be essentially the high of the parallel channel or resistance. So the two factors, the S&P level there and the S&P divided by M2 money supply, right there at 8,200, I think that's where we're headed, and that's where we could see that next big drawdown.
Navigating these conflicting signals across gold, equities, and fiat liquidity demands disciplined risk management rather than raw emotion. As Gareth Soloway's chart analysis reveals, whether gold retests major technical support before charging toward five figures, or the S&P 500 pushes into historic overvalued territory relative to M2 money supply, the upcoming market cycle promises unprecedented volatility. Position sizing and dollar cost averaging remain the most essential tools for investors preparing to capitalize on these macro shifts. Which asset class do you believe will deliver the ultimate hedge when the next liquidity wave hits gold, equities, or hard assets? Let us know your thoughts in the comments below. If you found this breakdown helpful and want to stay ahead of these historic market moves, make sure to like, subscribe, and turn on notifications so you never miss an update. Your support helps the channel grow and keeps you informed when the markets shift next.